Hello and welcome back to a new series. I'm starting a new series on financial maths. And we're going to start with the chapter 2, and it's called cash flow models. So the first thing we need to think about are what are cash flows? So cash flows are sums of money paid or received at particular times. And we denote a cash flow at time t by using the symbol CT. And we can easily tell if it's income or expense, because if it's positive, then it's an income, and if it's going to be a negative cash flow, then it's an expense. There's three things that we need to consider regarding the certainty of a cash flow. Firstly, we need to think about whether or not the timing is certain. For example, rent contracts will have certain timing because we know when we're going to pay rent. We know when we're going to pay rent. Whereas life insurance contracts can have uncertain timing because we don't know exactly when someone's going to die. So we don't know when the insurer is going to have to pay the premium. When the insurer is going to have to pay out. The next thing we need to consider is whether the cash flow size is certain. So rent has certain sizes. In the rent contract, it'll say how much rent you need to pay per month. But medical aid could have unknown sizes because you don't know exactly how much the insurer is going to have to pay out in medical aid bills. Maybe you have a small injury and you just have to pay out, 10,000 Rand, but maybe you have to go into hospital for a month and that's going to be a much bigger payment. So the size of the payouts are going to be uncertain with medical aid. The third thing we need to consider is whether or not there's a final payment date. So government bonds often have a final payment date, and this is called the redemption date. So this is the final date of the bond. And rent contracts often don't have a final payment date, so we regard them as a perpetuity. And a perpetuity means they'll go on forever. So we basically assume that you'll be collecting rent on your property forever. In this course, we make a few assumptions. The first assumption we make is that the timing of each cash flow is known. And the second assumption that we made is that the size of each cash flow is known. So let's have a quick look at an example. So this example asks us to describe the cash flows involved for the issuer of an interest-only loan, referring to certainty of payment, timing of payment, sign of the payment, and relative magnitude of the cash flows. And it also tells us that we can ignore the possibility of default. So the first thing we see is that there's going to be a large negative cash flow in the beginning, and this is when we give out the loan, so we can give out a lot of money. The timing and the amount of this are certain because we know how much we're going to give out and we know when we're going to give it out. We're going to give it out at time 0. Next, we're going to see that there's going to be regular positive cash flows, and these are going to be the interest payments. So we're going to receive interest payments monthly or whatever the contract says. And these contracts are going to be relatively small compared to the loan, and the timing of these are certain. So in the contract, it's going to say maybe they have to pay us interest every month. And the amounts of these interest payments could be fixed if we use a fixed interest rate, or they could be variable if we have something to factor in inflation. And then lastly, we're going to have a big positive cash flow. And this the amount is going to be certain. It's going to be the redemption amount. So it's going to be the same as the initial amount of the loan. And the timing could be known or unknown depending on whether early repayment is allowed. So sometimes early repayment is allowed, so then you don't know exactly when the loan is going to be paid off. So then timing could be unknown. Okay, so let's do a quick talk about redemption. So redemption is when they pay you back the initial amount. So if R equals 1, if redemption equals 1, then we say it's redeemed at par. If R is less than 1, we say it's redeemed below par. And if R is greater than 1, we say it's redeemed above par. Okay, so now let's look at a few examples of cash flow scenarios. So the first one we're going to look at is a zero coupon bond. We often can write a ZCB, just for zero coupon bond. And a zero coupon bond is a security that provides a specified lump sum at a specified future date and no other positive cash flows. So there's only 2 cash flows. The first one is when you buy it, you'll have a negative cash flow, and then at the redemption date, you'll have a positive cash flow. And this, it's important to think about the point of view that you're drawing the timeline from. And for most of the examples, we're going to be the investor or the lender from the point of view. So another thing that you can pretty much assume is that the redemption amount is almost certainly going to be more than the amount that you paid for, because otherwise there's no point in buying it, because if you're not getting it for more, if you're not getting interest or getting a benefit from lending them money, then there's no point of doing it. And then N stands for nominal, and it's often assumed to be 100. And then P is the price. So let's say we pay 80 Rand per 100 nominal, then this amount will be 80 times 100. So it could be 80 or however much nominal you bought. And then R stands for the redemption per nominal. So maybe, as we spoke above, if R is 1, then it's at par. Maybe R is like 1.2, then it's redeemed above par. So those are all things to take into consideration. The next one we're going to look at is a fixed interest security. So for a fixed interest security, the holder will receive a lump sum of a specified amount at a specified future date, as well as a series of regular level interest payments until the repayment of the sum. So we call the regular interest payments coupons for a fixed interest security. So we can see that over here. So we're going to have an amount that we buy it for at the time zero, and then we're going to receive coupons, often every month, maybe every year, depends on the contract. And then at some future time, we're going to get the redemption amount plus the coupons. So that's the timeline for a fixed interest security. Now we're going to look at something quite similar with a slight difference. It's called an index-linked security. So now the size of the coupons and redemption will be adjusted to be in line with inflation. So let's just do a quick recap of what inflation is. Inflation is defined as a measure of the rate of change in the price of goods. Okay. And then real terms are when you take inflation into account, and nominal terms are when you don't take inflation into account. So this is what one example of a index-linked security could look like. So at time zero, you'll buy it for some price. And then let's say each month or each time period, you'll get some coupon. And the coupon amount will vary depending on the price of some index. So you often use the CPI, the Consumer Price Index, but there's many others you could use. And depending on the Consumer Price Index, the coupons you receive will vary. They could go up, they could go down. But the most important thing is in real terms, the coupons will stay the same. And then at the end, you'll get your redemption, which will also be adjusted to be in line with inflation, plus your last coupon. So for an index-linked bond, the coupons and redemption will be the same in real terms, whereas but the nominal amounts will differ. Whereas for a fixed interest security, the nominal amounts of your coupons and your redemption will stay constant, whereas in real terms, this could change due to inflation. The next thing we're going to consider is cash on deposit. So a cash on deposit is when the investor can choose to disinvest and will receive interest during the period of investment. So an example of cash on deposit will be a bank account or maybe even a 32-day notice account. Okay, nextly we're going to talk about equities. So equities are securities that are held by the owners of an organization. And equities are also often called shares. And so you receive a share in the company's profits and dividends, and the share price if you sell it. So these are the cash flows. So you'll get dividends maybe every month. You'll get dividends maybe every year, and then you'll get the current price of the share if you decide to sell it. When we talk about equities, you often consider them to be perpetuities because if you assume the company will never fail, then you could just hold it forever and get dividends forever. So again, perpetuities will go on forever. The next one we're going to talk about is an annuity certain. This provides a series of regular payments for a fixed term in return for a single premium. This one's very similar to a fixed interest security, except there's no redemption amount. So here we'll pay a price for it and we'll get a certain number of payments back, regular payments. So maybe we pay in, 1,000 Rand, and then we get 120 Rand for 10 years, for example. The next one we're going to talk about is credit card. So a credit card allows flexible borrowing, which can be repaid partially or in full each month. And it's also called revolving credit. Most people know credit cards. The next one we're going to talk about is a current account. A current account is a bundled product allowing for saving or borrowing through overdraft. So it's quite similar to a deposit, cash on deposit, except now you have the ability to borrow. So cash on deposit, you're only allowed to deposit. But now you can deposit money and you can earn interest on that, or you can borrow money and you can pay interest on that. Okay, an interest-only loan is a loan that is repayable by a series of interest payments, followed by a return of the initial loan, and the cash flows are the reverse of a fixed interest security. So this should look very familiar, except everything was flipped around. So before it was like this, now everything's flipped around. So now you get an initial amount. You pay coupons maybe every month, maybe every year, whatever the contract states. And then at the end of the period, you pay the redemption amount. A repayment loan, which is also called a mortgage, is a loan that is repayable by a series of payments, each including a partial payment of the loan capital in addition to the interest payments. So you'll get a loan amount, and then you'll have to pay. Sometimes it's constant amounts per month, sometimes it varies, but you'll have to pay an amount each month or each year. And the repayments will include some of the interest and some of the capital repayment. And as it says here, interest is calculated based on the outstanding balance. So as you pay off the outstanding balance, the interest amounts will go down. So in the beginning, your payments will almost always be almost completely interest, and only a tiny bit of capital will be repaid. But as you go on, there'll be less interest that you're repaying and more capital. And the cash flows are similar to the reverse of an annuity, certain if the payments are level. So if you have your payments being constant for each period, then it's going to be the reverse of an annuity certain. And this is just a quick graph I drew, showing how the outstanding balance changes over time. So in the beginning, you're barely paying off anything, so it stays pretty constant. You're mostly just paying interest. But after a while, when you start decreasing the outstanding balance, then the interest goes down, and then the amount you're paying will be mostly interest, and eventually you'll be paying basically only capital, and then you'll eventually get to zero. This is an example of like a 20-year mortgage. Okay, so those were some finance products, but now we're going to look at some insurance contracts. So the first one we're going to look at is a pure endowment. This is an insurance contract that provides a lump sum benefit on survival to the end of a specified term. So the most important thing about this is it pays out on survival. And let's have a quick look at an example. So let's say you get a payment of 100,000 Rand if a life is currently age 25, survives to 60. So let's say you're a 21-year-old and you buy this pure endowment, and if you survive to 60, then you'll get 100,000 Rand. But if you die before 60, then you get no payment. So let's look at the two scenarios. So if you survive to the end of the term, so you'll make payments maybe every month. So you'll make these constant payments, and then this will be the end of the term. And if you survive until here, you'll get your big payout at the end. However, if you die before the end of the term, you'll still make these payments until you die. So we'll say this is the point when you die, between these two intervals, and then you'll stop making the payments, and you also won't receive anything at the end because now you have passed away. So when you die, the payments stop as well. So that's something you need to think about. And sometimes a lump sum can also be, the premiums can be paid in a lump sum. Okay, so now let's look at a term assurance. So this is an insurance product that provides a lump sum benefit on death. So the previous one was on survival, this one's on death during a specified term. So let's look at the two options. So if you survive to the end of the term, then you'll pay out every month, for example, and at the end of the term, it pays out on death, so you never died, so you won't get anything at the end. However, if you die before the end of the term, then they'll pay you out. So you pay the insurer every month, for example, and then you die here, and then they pay you out at this point because now you've died, and it pays out on death. And then obviously you won't pay out any more premiums because you've passed away and you've got your benefit. Cool. Now let's have a look at an endowment assurance. So an endowment assurance is a contract that provides benefit on death. Okay, so on death again, during a specified term, or on survival. So it kind of looks like a combination of the two. So you get paid out on death, or you get paid out on survival to the end of the term. So endowment assurance is kind of like a combination of term assurance and pure endowment. So I've kind of combined the diagrams together here. So here you pay your monthly premiums, and if you die during the term, like let's say you die at this point, then you will get paid out here. But if you don't die, then you will continue paying monthly premiums. I should have some arrows here. Continue paying your monthly premiums until the end of the term. And then if you survive, you also get paid out. So no matter what happens, you get paid out. It just depends whether you get paid out on death or on survival. So that is an endowment assurance. So now we're going to talk about a contingent annuity. So a contingent annuity provides a series of regular payments where the payments are contingent upon certain events, such as survival. So there's a few options. Here's a few examples. So one example is a single life annuity. So this is where the regular payments made to the annuitant are contingent on the survival of that annuitant. So an example of this could be a pension. So maybe each month you get, 30,000 Rand, but if you die, then the payments stop. So that would be an example of a single life annuity. A joint life annuity is where the regular payments are contingent on the survival of one or both of those lives. So let's say you and your partner are married, and then you get a joint life annuity. So if you're both alive, then you get regular payments. If one of you dies, the other one still gets the regular payments, but then when both of you die, then the payments stop. That would be a joint life annuity. The next one is a reversionary annuity. So this is where the regular payments start on the death of the first life, if and only if the second life is alive at the same time, and then the payments will continue until the death of the second life. So let's say person A is married to person B. You don't get any payments until person A dies, and then person B will get payments until person B dies. So that would be an example of a reversionary annuity. And sometimes it's called a spouse's or a dependent's annuity. So let's say a husband works and the wife looks after the children, then you could get a reversionary annuity. So then if the husband dies, then the wife will get regular payments to help look after herself and maybe the children until she dies. So that would be an example. And a pension payable after retirement, as I said earlier, is an example of a contingent annuity. Next, a car insurance policy. It provides payments to cover any damage to the insured vehicles, which is called property cover. So this is covering your vehicle, property cover, or damage by the insured vehicle. So if you crash into someone else and it's your fault, then this would be liability cover. But if someone crashes into you and it's their fault, then it's property cover. Or if you crash into like a tree, then it's property cover. Car insurance usually lasts for 1 year and premiums are usually paid monthly. Finally, we're going to look at a health cash plan. So this provides payments to cover medical expenses such as hospital treatment, and it usually lasts for 1 year. Cool, so this was a quick summary of chapter 2. I hope you enjoyed this video and I look forward to making the rest of these videos for this series. Have a good day.